Welcome to the Allan Small Financial Show. Thank you for taking some time out of your busy day to share it with us. This is our first show for the new year, so I want to wish everyone watching a very happy new year. I hope everybody had a restful past 2 weeks, or I guess now 3 weeks. I know that things can get quite hectic towards the end of the year with all that holiday shopping and running around. Kids are finishing school, doing their, holiday concerts, etc. So things get quite hectic. So hopefully everybody was able to have some rest over the last few weeks of the year and spend some time, some quality time with family. And, over the past few weeks, I've been talking to a lot of investors. And as always, we get our topics for this show from our investors, from our clients, from investors I speak to on the street or by phone. And I think we have a great list of topics for today. As you can see here, we're going to talk a bit about a bunch of different things. First, we're going to talk a bit about the stock market. Off to a bit of a choppy start, but things have gotten a lot better since we saw the jobs data that was reported last Friday, both in Canada and the US. Stock market has definitely fared quite a lot better to start this new week. We're going to have our, as usual, this week segment where I talk about what I believe is important for individual investors to consider before they make their investment decisions over the next couple of weeks. We're going to talk about Canadian banks. There was a survey out of CIBC talking or mentioning that Canadian banks probably wouldn't be doing as well this year as previous years. We'll speak a bit about why and if I agree and if I think that's going to be the case. Ontario taxes, very interesting statistic out of the Fraser Institute, which is an independent body, talking about how Ontario has the third highest tax rate when you factor in federal and provincial taxes, or when you look at federal and state tax, we're the third highest jurisdiction in North America. So that I thought was quite interesting. We'll chat a bit about that. What is a slow session? Most of us know what a recession is, unfortunately. But what's a slow session? Well, a new term that's been introduced by Moody's over the past month or so. Last but not least, tech sector growth. Is it a good time to invest in the tech space? A lot of tech names have sold off significantly since their highs. Is this now an opportunity? And last but not least is your questions. We'll take a few of your questions before we sign out. And hopefully we can get to a bunch of them. We usually get to 2 or 3 by the end of the show. So without further ado, let's move forward. Coming into this new year, the stock market was, I guess, on a bit of a down note. Usually we're used to seeing a bit of a Santa Claus rally. Most years we see an uptick for the month of December. This past December, we didn't receive that, or we didn't get that. The markets actually sold off into the end of the year. We saw maybe 1 or 2 days were positive towards the end of the year, but for the most part, I think for investors, there was this negative sentiment, negative feeling. The path of least resistance was to the downside. But as we turn the page to a new calendar year, I think the worries have started to change a little bit. We used to be worried more about higher interest rates and inflation. Now, don't get me wrong, those are still worries for the average investor, but now I think those have now morphed into something a little different. I think the average investor now is more concerned with earnings. How are businesses going to fare? Will there be a slowdown? Is this talk of recession actually going to happen? Because if it does, obviously that means that the stock market will reflect it and we'll continue to see some difficult markets. So I think going from higher interest rate fears, inflationary fears, now into what does this mean for business and what does this mean for the stock market? However, we got some really good news this past Friday, first week of the trading year. We received jobs data. And I think we have some charts that show some jobs data, both here in Canada and in the US. You can see here the upward trend on the Canadian jobs data. We continue to trend higher and higher, even though the jobs growth might be slowing down overall. We saw some really strong numbers, over 100,000 jobs created for the month of December. We saw that number posted last Friday. US chart we can show as well. They grew, the US that is, grew jobs well over 200,000. They were expecting a number in and around 200,000, and they grew about 225,000 jobs for the month of December. So what is that telling us? Well, in my opinion, it's telling us that this market continues to be resilient. And the market actually rallied on good news. What a concept. For quite some time, good news had been bad news. But here we were seeing strong jobs data. But the market actually rallied. And why it rallied was we saw some lower inflationary data around this jobs number that we saw on Friday. We saw average hours worked down. We saw wage growth down. We saw a services sector, pricing in the services sector start to fall as well. We saw services actually come in showing a bit of a contraction. These were all the things that the Federal Reserve and Bank of Canada had been worried about that was driving up inflation. Wage inflation was really hitting home with these overall inflationary data. So not only are we seeing jobs continue to be there for Canadians and people in the US, Americans in the US, we're seeing inflation fall at the same time. Kind of the best case scenario. This soft landing scenario that many were hoping for, that the Federal Reserve and Bank of Canada were hoping for, something that many of us thought was impossible. Well, maybe the Fed and Bank of Canada are getting it right. And that's why the stock market has rebounded significantly this week. Starting with Friday, I think the Dow Jones was up over 700 points. TSX was up. NASDAQ was up. S&P 500 was up. Followed into this week. Monday, we saw a bit of a correction midday with some Fed governors trying to spoil the party and talking about how higher interest rates would affect us. But overall, this market is actually powering higher based on this idea that we could actually continue to see growth with jobs and even perhaps small growth in our economy, but at the same time bringing down inflation. And if we see that, we'll all get that soft landing, as I've spoken about many times, or that, scenario where we bring down inflation, but yet does not pull us into something significant to the downside like a recession. If we can do that, I think the job of the Fed and the Bank of Canada would be bang on, and we should tip our hats to them. So this is our This Week segment, and this is where I discuss what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. As you can see here, we're going to touch upon three things, as we always do. This week, we're going to talk about economic data to watch, corporate earnings season's about to kick off at the end of this week, and contrarian investing, something I touch on every now and again, but I think it's really important to think about being a contrarian at this time, beginning of the year, when so many things are so cheap. So let's start with economic data to watch. Probably the most important economic data that will be coming out starts tomorrow. We're going to see or receive inflation data out of the US. CPI will be reported tomorrow. Next week, we're going to get Canadian inflation data. And the Fed and Fed governors have already said that they're going to be looking at this number very closely tomorrow in the US. Bank of Canada, I'm sure, is looking at the number that will be coming out in about a week's time. So this CPI report will be crucial to what the Fed is going to do at their next meeting. Will they raise 25 basis points? Will they raise 50 basis points? Right now, the market is believing that 25 basis points will be what will happen. But if we do see a hot inflation number, perhaps that goes to 50 basis points. And I think we have some inflation charts as well to put up that we can show, showing that inflation is starting to come down. There's a Canadian inflation. You can see the chart going straight up almost, and then coming down towards the end there at the end of last year. We're sitting at a rate of just under 7%. I'm sure the Bank of Canada would like to see this number a lot lower, a lot closer to 2%, but we've come down from about 8% or over 8% to now just under 7%. In the US, I believe we have a chart on that as well. They've come down from 9% to about a 7.1% rate. And when you take out the volatile food and energy, you're looking at a number that's in and around 6%. So Economic data will be crucial for investors to consider when you make your investment decisions over the next few weeks. Corporate earnings season, I guess the second topic I wanted to touch on today, that is about to begin. Now, we have received some earnings recently. Nike reported a fantastic result. I think as China reopens, Nike is definitely benefiting from that. But overall, corporate season, the way we look at it, really doesn't kick off until we get the US banks reporting earnings, which will happen this Friday. Four of the largest banks in the United States will be reporting their last quarter, how they fared, what are they seeing going forward. And as we know, banks are the bloodline of any economy. So if banks are saying things are getting a little bit more difficult, we're seeing a slowdown in the economy, obviously that won't bode well for the overall stock market. But if these banks are saying they see a strong consumer, as they have been saying, and if they continue to say people are spending, they're using their credit cards, and they still have savings in their bank accounts, that would be a positive for investors and the stock market. And I think that the banks have probably the best look at, or what they tell us is the best viewpoint for individual businesses going forward. They give us where things are at. They are able to tell us where things are at. So here we have Bank of America, a chart that you're looking at. As many of the bank charts we're going to put up here, you can see how far Bank of America has come down roughly about 30% from its high. Bank of America makes a lot of money from what we call net interest margin, the spread between what they pay individual investors and what they charge for loans. So the spread there, Bank of America is one of the best. They make a lot of money from that. If we go to the next bank chart, JP Morgan, the largest bank, one of the largest banks in the world, definitely largest bank in North America, they're going to report as well. And you can see that their stock prices come up quite a bit. Very different chart than Bank of America, which is still down by quite a bit. Another bank chart we could pull up here, Citibank. Again, you can see towards the end of this chart, Citibank has ticked significantly higher, down to about $40 a share. Today it's 48. This bank is interesting because it pays over a 4% dividend. One of the few that pay over a 4% dividend of the US banks. Actually, they're the only bank that pays over 4%. And last but not least, Wells Fargo. I think we have a chart on that as well. And you can see, for the most part, with the exception of JP Morgan, you can see all these banks have started to do a lot better towards the end of last year. But corporate earnings and the kickoff to corporate earnings is definitely something I believe individual investors need to focus on as they make, of course, their investment decisions. The last topic I wanted to discuss or to mention to individual investors is this idea of being a contrarian approach to investing, and why I think today it's really important. When you look at where the stock market ended 2022, a lot of the stocks were down 20%, 30%, maybe even more than 40%, especially if you consider some of the sectors like technology, which we'll touch on later in the show. But being a contrarian investor, it takes an iron stomach sometimes to get into an investment idea when everybody else is bailing out of it or selling their shares. It takes an iron stomach to buy something when it's at a low, when everybody is saying that this is not a name that you want to be in right now. I think actually gives us an opportunity to buy things on the cheap. If you want to buy low, sell high, as the saying goes, you have to look at some of these fallen angels, some of these names that are good quality, but for whatever reason are just down right now. And if you believe that some of these names will be higher in the future, these are the names that I think you want to get into. And so you have names, a lot of names in some of the tech space, like an Amazon or a Meta, which we'll talk a bit about a little later. These are names I think you could take a look at. This whole notion of contrarian investing, buying when those are fearful, something that Warren Buffett made famous a long time ago. You could look at other sectors as well. We touched on banking, but you could look at retail. There's some names even in pharmaceutical, a sector that did quite well last year, that I think you can get into this year that didn't do as well as some of the other pharmaceutical names. So being a contrarian, I think, affords you the opportunity to buy into some good quality names that are extremely cheap, so that when things get better, maybe not in the next month or so, maybe 6, 12, 18 months from now, I think you could, by being a contrarian investor, I think you can do fairly well in a lot of these good quality names. And of course, if these names pay you a dividend while you wait for that growth, while you wait for a rebound, in my opinion, that's always the best recipe for success. Canada's banks, a topic or a sector that many individual investors in Canada always focus on. I was talking to someone just the other day. I had a meeting, and they said that they were talking to someone who had been very successful in the investment world, and they said, and the advice that this person gave to them was, just buy the Canadian banks. You can never go wrong over time. And they asked me if I agreed with that philosophy, and to me, the answer is yes. I think Canadian bank stocks is really the core that I use for many of my clients' portfolios, many of investors' portfolios, especially living here in this country, when the top 5 banks really run the show here. We do have other banks, smaller banks, but the top 5 sort of have a monopoly on the business in this country. Owning these top 5 banks makes a lot of sense. If you look at a chart of these banks, you'll notice that it goes from the bottom left to the top right. This is a 1-year chart, sort of showing the opposite for Bank of Nova Scotia. But if you were to extrapolate that chart over a period of many years, you will notice that names like Bank of Nova Scotia and some of the other larger banks, they go up over time. And they have always increased their dividends. They've never decreased their dividends. So when CIBC puts out a report, or I believe it was a survey, a report recently saying that Canadian banks won't fare as well in 2023, that they see a bit of a softening of earnings out of the bank, people take notice, and people are wondering, is this true? Can we still invest in the banks? And I think it will be true. I think that the banks still make most of their money here in Canada by lending. And if an economy is slowing down, we will see a slowdown in lending. A lot of that will come on the corporate side. I still believe that people will continue to borrow money to buy a home, maybe not as frequent. Home sales, we know, are already down, so that is affecting some of the lending that banks do. But also on the corporate side, if we're seeing a slowdown in the economy, businesses won't be as quick to borrow money to grow their business. We also, in a slowing economy, don't see as many companies going public. We don't see as many mergers or acquisitions. We don't see a lot of that. And so banks tend to make a lot of money when they're involved in these types of things, bringing companies public, involved in advising mergers and acquisitions, etc. They could do well with respect to trading if we do see high rates of volatility. Trading profitability could go up because banks will make more money if in a more volatile market. But overall, I think we will see a slowdown. And if we are headed into some sort of mild recession or a significant slowdown, and as I said earlier, banks are the bloodline of an economy, this will affect our banks. And if we could put up the chart of Bank of Nova Scotia again, when you look at these banks and coming into the year that we're having right now, a name like Bank of Nova Scotia, as you can see, about $67 a share, it once was in the mid-90s. So you're looking at a stock down about 30%, a stock that's paying over a 6% dividend right now. If this stock were to just get back to maybe $80, $85, so make back, let's say, half of the losses that it had from the highs, plus a 6% dividend, I think this is a fantastic opportunity for individual investors, of course, that can handle the risk involved in owning a name like Scotiabank. But I think it's an opportunity to do well. You could possibly make 20% return combining a capital gain with a dividend on a name like Scotiabank. And when you look at CIBC Bank, another bank that also is paying over a 6% dividend, a name that you could see has fallen significantly, these banks represent tremendous opportunity, in my opinion. Even some of the larger banks, Royal Bank, TD Bank, they're paying over 4% dividends. When we look to banks, we usually consider them raising their dividend once or twice a year on average. So a lot of people have been asking me, Allan, which banks do you think will be raising dividends this year? I think that's a difficult question to answer. But if I had to, I guess, pinpoint one bank that I believe could raise dividends, that I see them raising dividends perhaps more than any of the other banks, top 5 banks, I would say Royal Bank, the bank that you have on your screen right now. They just made a pretty big acquisition in HSBC, bought the HSBC business that's here in Canada. But I still believe that Royal Bank has enough money, enough profitability to be able to raise their dividend this year as they've done in years past. I also think that a name like Bank of Montreal probably would be there to raise dividends as well. But we'll see if all top 5 banks in our country raise dividends. But those two in particular, especially Royal Bank, I think will be there to raise dividends. So overall, I think Canadian banks remain an opportunity for individual investors, especially those that have been hit hardest. Scotiabank, CIBC Bank, they're paying over a 6% dividend, while the others are only paying 4%, which is still a good rate, but 6% is a lot higher than 4%, and they represent opportunity for growth. So even though I think there will be a slowdown at the banks, I still believe they represent a good investment idea for individual Canadian and international investors. Ontario taxes, and this is something we sort of added in for the show, kind of, I don't want to say last minute, but that was probably the last topic we wanted to discuss. And this was because I read an interesting report out of the Fraser Institute, an independent body, and I found it interesting to note, as I said earlier in the show, that living here in Ontario, as I do, we are actually the third highest. We actually have the third highest level of taxes of any jurisdiction, and that is state or province. When you combine provincial taxes and federal taxes, or state taxes and federal taxes, Ontario has the third highest in North America. The highest tax bracket is somewhere around 53%, which for those that are living in Ontario, it's quite unbelievable. And I know that provincial government, now going back a bunch of years, has said that they want to do something about that they want to bring down the taxes so that we can be more competitive in this jurisdiction, in this province. And you could see when taxes started to move significantly higher, it looks like 2012, 2013, and they've kind of stayed that level for the last bunch of years. But my fear now is when you combine this high level of taxation and you combine that with higher interest rates, higher inflation, because even though inflation has come down, it's still 7%. The average person living in this province, they're getting hit pretty hard. The average business in this province is being hit with higher rates, higher costs. And it leaves or begs the question, how competitive are businesses? Would we be more competitive if we were to reduce taxes, if our government were to reduce taxes? How much more competitive would we be if we can bring down inflation, bring down taxes, and allow businesses to thrive? This is something that I talk about with individual investors on a regular basis. I talk to small businesses on a regular basis. Coming out of COVID, obviously COVID did not help. Talking to Dan Kelly a few months back, we see that individual businesses still have not come back to where they were prior to COVID. So unfortunately, for those of us, trying to grow a business and make a living in this province, it's becoming increasingly more difficult. And I guess my hope is that the current government at some point will look at where our taxes are and perhaps try to do something to bring down some of these higher rates that we're seeing in Ontario versus the rest of the country and versus the rest of North America, including all states in the United States. Slow session, and I know that we had the wrong headline there, but that's okay. A slow session. That was a topic or an idea or I guess a concept that was introduced recently by Moody's. Moody's Analytics talk about the word slow session. And everybody's like, well, what's a slow session? We know what a recession is. We know what a correction is, but what's a slow session? And really, this word slow session came from Mark Zandi, who is over at Moody's Analytics or over at Moody's. And what a slow session pretty much is a slowdown in the economy. We know that a recession is 2 negative quarters of growth or negative quarters of GDP. But a slow session, really what they're saying is they believe the economy is gonna slow down all the way to the basically the break-even point, but not go into the red, not be negative. So Moody's, for example, is not predicting a recession for 2023. They're predicting a slow session. Now, if you ask me, I'll be honest, I couldn't care less, really. The term recession, slow session, doesn't really matter, and it shouldn't matter to all of you as investors. What does matter is things are slowing. Business is slowing. All the CEOs that you see on TV or that we get a chance to speak to at their businesses, they're all telling me the same thing. Business is slowing down, and businesses are having to right size to become more, to adapt more to the new environment, the environment that they predict we will be in 2023. So what does that mean for jobs? Well, it could mean higher unemployment. What does that mean for inflation? Well, hopefully it brings down inflation. So hopefully this slowing of the economy or this slow session helps the Bank of Canada, helps the Federal Reserve bring down the inflation rate. And I think that's what everyone is counting on. Slow things down, but not enough to take us into a recession and not take us into a deep slowdown. Maybe it'll be a shallow, short-lived one, which is what we're seeing with the jobs data that came out late last week, which is, again, why the stock market has been rallying. So overall, if you hear the term slow session, it just means a slowing of the economy, but it's definitely better than the alternative, which would be negative growth or a recession, which we all don't want to be a part of. Tech sector growth. Now, interesting, we heard something from a pretty well-known banker out of Bank of America recently, and he talked about how he believes the tech sector will outperform in 2023. And coincidentally, Wells Fargo just put a top pick rating on the chip makers, the semiconductors, as we call them. So all the companies that produce the chips. Well, I shouldn't say all, but a bunch of them. Names like AMD, names like NVIDIA, Marvell. So here we are starting to hear that analysts, investors, advisors are starting to talk about the tech space. Now, why are they doing that? As I spoke about earlier in the show, contrarian investing. What goes down at some point comes up. What gets hit the hardest probably goes up the most. And if you own good quality investments, I think this is true. So there are a number of tech names that have been hit extremely hard over the past year. A lot of these names, and we'll show you a couple, have been cut in half. Let's pull up a chart of Amazon. You can take a look at Amazon. Amazon stock, once upon a time, was about $180 after they split. It used to be a $2,000 stock, but it split 20 for 1. This stock was $180 at one point. Today, it's below $90. So actually, just yesterday, reached the $90 mark. So basically cut in half for a name like Amazon. $1 trillion market cap, roughly. One of the biggest names, one of the names that we all use on a daily basis. Now, during COVID, they grew a little bit too much. People were at home. They needed more fulfillment centers. They need more people working at those fulfillment centers to get the packages out to the people that were ordering them from their home. And once we all now came back to the malls, came back to the stores and shopped in person, we didn't maybe use Amazon as much. So what has happened in Amazon? They've had to right-size their business. They've started to slow down. They've laid off a bunch of employees. They've closed some of their fulfillment centers, and they're trying to right-size their business once again. And Once they do that, I believe Amazon will start to move higher again. And we've seen Amazon on lists of individual investors' top picks. I think we also have Meta, if I'm not mistaken. Now, Meta, formerly called Facebook, you can see here, Meta is down by 60% from its high. So a name that has just been thrown out by many investors, a lot of it having to do with the amount of money that Mark Zuckerberg has been spending on the metaverse, which doesn't produce any profit at this point. So a lot of people, a lot of investors were upset, and they started selling the stock because of the amount of money that Facebook or Meta was spending to get the metaverse up and running. And but I believe this is an opportunity because everybody is forgetting that there are about 2.5, 3 billion people using Facebook's apps or platform every day. That's a powerful tool. And we're starting to hear more and more the adoption of Instagram Reels and stories. People are starting to use them. And I think this is a name that has been hit extremely hard, too hard, and could represent good value to individual investors going forward, once again, if you can handle the volatility. So tech sector growth, I think we're going to see it. I think we're going to see it in many different areas of tech, whether it's software, whether it's the FANG stocks, as we talk about, the Facebook, the Amazons, the Googles of the world, Microsoft. I know people have been a little bit down on Microsoft lately. Their CEO has spoken about how the next few years will be a challenge. But I think, I think that's the CEO setting a low bar. And I think he sets that low bar so it can be beaten. And that stock can rise again. And, Microsoft is down 25, 30%. So I think tech sector growth, I think we're going to see it. I think we need to see a pause in interest rate hikes before we do see the tech sector move higher again. But I think that's going to happen in the first quarter of this year. And when we do get that, I think you could see the tech space, the NASDAQ in general, move higher, especially in the second half of this year, but overall higher for 2023. Now the part of the show where I get to move into or delve into some of the questions that I've been receiving from you, the listener, the person who's watching. And I know we usually try to get to a few of these. I'm looking right now. Pretty simple question right off the bat. What is your investment philosophy? Interesting question, pretty straightforward. I guess my investment philosophy has always been buying individual names that are good quality, that are cheap. And I know most people are going to say, yes, that's obvious. But I take on more of what we call a GARP approach, growth at a reasonable price. That's what GARP stands for. And what I mean by that is, some investors will look for investments that are dirt cheap, rock bottom prices, on sale, and ridiculously low price. And that may have made sense back 25, 30 years ago. I think over the last decade or two, we kind of went away from that. It was more growth at a reasonable price versus growth at rock bottom prices. So, and the difference in my opinion is because the tech sector and many of the sectors just really took off. And so instead of waiting for a lot of these good quality names to be down at low pricing, you just wanted to buy a name that made sense from an earnings perspective versus its price. So it didn't have to be ridiculously low in value or in price. It just had to be relatively cheap based on the earnings of the company. So a GARP approach makes sense to me. And that's always been, or at least I guess it's been this way for the last maybe 10, 15 years. GARP approach to investing makes sense to me. I used to be a deep value guy, changed over to the growth at a reasonable price, maybe about, as I said, about 10 years ago. How do you track your clients' investments performance? A good question. Well, we have fancy software that does that for me. I'm actually old school in that I like to take a piece of paper and a pen and I write down everybody's investments. And when I do a portfolio review, I take a look to see who's up, who's down, what's flat, what's working, what's not. So I guess, overall, when I do reviews, which I do, I like to do them on as frequent as possible. Usually I review everybody's portfolio in my business every couple of months at the very least take a look at how the performance is doing, and I try to communicate that to my investors as frequently as I can. And so that's what I do, and how often I look at investors' performance, and how often it gets tracked. We'll try and squeeze one more question in here. Why would I invest with you instead of a bank? Would a bank give me more security? Another great question, and I get this question from time to time. I'm an independent investment advisor. The Allan Small Financial Group, we don't have any proprietary products. I have no bias. I try to build portfolios out of the best products at the time I'm building the portfolio, what I believe is going to work to reach my clients' investment objectives and goals. I don't have a bias towards one product or the other. Unfortunately, for those that are at a bank, some of the banks, all the banks have their own proprietary products. They also have their pre-created portfolios. So when you meet someone at a bank, you usually get slotted into a portfolio that's already been created. I build portfolios from scratch. So for me, it's a big difference between going to a bank firm or going to your bank branch and using someone like myself. I probably have, well, definitely have more goodies in my bag to present to you than the bank branch would. I don't have any biases. I build portfolios from scratch. So there are a lot of differences between using someone like myself and going to a bank branch or a bank-run firm. And I know a lot of people invest with banks, and that's fine. But independent investment advisors, I think, have an advantage in that we don't have any set guidelines. You know, I build what I think is right for my clients. And I think that's all the time we have for this show. I think we ran a few minutes longer than normal. So I just want to say once again, thank you all for watching today. Happy New Year once again. And I look forward to seeing everybody in a couple of weeks, January 25th at 12 noon on Wednesday, the 25th. And until then, happy investing. And let's see what the economic data tells us.